Good morning and a very warm welcome to all of you. Thank you again for joining us. This is actually the second webinar in this three-part series. For those of you who are joining us for the first time, we are doing these webinar series because this is a part of an online bootcamp for Bharat Innovates 2026. And this is a special opportunity which is being extended by Ministry of Education and PSA so that Indian deep tech innovations can be showcased at a global stage. So as most of you would know, that the first shortlist for the program is out, and we are doing these webinars to help you prepare for the national showcase, which is supposed to happen very soon in IIT Gandhinagar. So, as part of this program, you are going to get a lot of opportunities to interact with investors. And that's the precise reason why today's session will be focused on investments. And we have Mr. Abhishek Kakkar, who is VP Investments from Indian Angels Network, to guide us for the pitch preparing and types of equity and different investor expectations. Before I pass it over to you, Abhishek, I just want to remind the attendees, please keep your questions rolling in, type it in the chat box. I will try to take them up with Abhishek after his talk, and those which I can't, you guys can email me and I'll try to get it answered from Abhishek. So over to you, Abhishek. Delighted to have you here and very excited to learn from you.
Thank you. Good morning, everyone. I'm Abhishek, VP of Investments and Sourcing at Iron Group. And Rashi, just confirm if the slides are moving.
Yes, it is. Your slides are moving. Perfect.
Okay, perfect. So I'm part of Iron Group. For those of you who know us as Indian Angel Network, you might think of us as just as angel platform. But today, Iron Group is one of the single largest horizontal platform for early stage investing in India. We don't just write early stage checks. We are a full stack investment ecosystem comprising of Iron Angel Fund, a Cat 1 AIF. We have Iron Fund 1. We also have Alpha Fund and Bio Angels. I'll talk more about all of these in a quick detail. So from Iron, all of these three funds combined, we have cumulatively invested into some 300 odd companies across deep tech to consumer products at this point, varying at various stages, and which includes, unicorns like Spinny, Drua, Unifor. A bunch of our portfolio companies are on their track to basically be unicorns, and they have helped us bring in stellar results for our investors back in the day. Um, a quick one about me. Personally, my background spans across entire life cycle of startup building, right from my own startup days when I was building SaaS products, built GTM strategies, business development operations cross border, and then I moved to help scale, startups scale up from seed to Series A, Series D with Magic Pin and 91 Springboard, and moved into early stage investing at Arca Venture Labs in 2020. So during this time, I saw a bunch of transactions, an equity hire for my own startup in 2013. Uh, in the same year, we saw the team that equity hired us got an acquisition in the US. And that's where I, got experience of, both sides on the transaction side, on fundraising, on what it takes to basically get out of the death of valley, right? Now quickly, today I'm at Iron Group. The way I define my role is basically I'm an apprentice for good people's good capital. So we provide early growth stage capital. My primary focus is sourcing series pre-seed to series A opportunities at Iron Group, and where we invest across these funds, right? And Fund 1 is fully deployed. 71% of our capital has gone into investing into companies across agri-tech, manufacturing, deep tech, healthcare, space tech, and clean tech. Uh, Most of them have basically raised their follow-on rounds and are in a position to provide very good returns for our investors at this point. Uh, we have a newly closed $100 million fund, 870 crores, Iron Alpha Fund. This is the second growth fund that we have, and we are continuing our vision to support 500 startups. We are at 300 plus companies today, and deploy 5,000 crores there to create 5 lakh jobs by 2030. So we have many more funds to come, lot more in our vision to scale and build a platform in India. Our geographic focus will be India. Special focus on tier two, tier three founders. We are looking at post PMF opportunities from this fund. Broadly sector agnostic, but we have a core focus and laser sharp focus on deep tech sector, encompassing healthcare, deep tech, space tech, semiconductors, industry, manufacturing tech, climate, and agri. And then opportunistically, we'll also look into some consumer. Now, to go deeper into some sunrise sectors, some frontier opportunities, we have also launched Bio Angels, and this is in partnership with BIRAC, Department of Biotechnology. Just hold on a second. Department of Biotechnology, when we are looking to invest and support early stage companies which are up to TRL 5, TRL 6, and helping them scale through various stages of their growth and subsequently invest from a growth fund as well. Here, our ticket size varies from 1 to 6 crores. And going back, in Alpha Fund, our ticket size will vary between 1 million to 3 million. So think 25 crore per startup to begin with, and then we will average it out with more subsequent fundraising pro rata as well as fresh infusion of capital. All right. So about today's topic. So the idea was to basically help you understand when we are preparing for fundraising, and I have had witnessed journeys of many startups over the years, right from the pre-seed stage to scale up, and how it all begins, right? And again, some of these factors, some of these practices and discipline is common across all stages. So we'll just talk more about that, and essentially then work towards deeper aspects of nuances of each and every element that goes into fundraising process and what takes the founder's mind share. And the idea is to put our perspective from the other side. So I work with a ton of investors. We have 500 plus angel investors on the angel fund. These are CXOs from various organizations who have had experience not just by education but working for decades on scaling businesses in their respective domains, and at the same time also investing in various domains. So they have dual experience there. So we are leveraging that cross learning, that network effects of knowledge that comes along having these investors on our fund. So the idea was to basically bring that perspective out. Now, Warren Buffett, my idol, uh, he said that in looking for people to hire, you look for three qualities: integrity, intelligence, and energy. If they don't have the first, the other two will kill you. And this is so true. And this echoes with me when I was started working with Ann Group, started listening into various investors into their perspective, our investment committee, uh, start talking to our co-investors, fellow colleagues and peers in the ecosystem. And this is very true. And the reason I say this is when what we look for in a founder, we meet 100 founders in a month, right? The ones that usually get funded have three things in common: their grit and execution capabilities. Ideas will be plenty. We bet on the founders first. We are looking for passionate, execution focused, obsessive founders and leaders, especially from tier two, tier three cities who actually have the the grit to build out in limited resources. We want to witness those footprints when you're building up. We're looking for complementary talent in the team. So deep domain expertise paired with business acumen, tech talent, and go-to-market expertise. Now we're looking for scalable solutions with massive market opportunities or fast-growing sunrise sectors with a clear path to revenue and defensibility via IP, distribution scale, or effectively network effects. Now, this essentially encompasses along on top of what we look at within the founder. We primarily focus on qualities like their integrity, their understanding and knowledge of the ecosystem, and the kind of energy they bring on the table. They have to build teams. They have to build teams which will basically carry that culture as well. Now, this essentially should give you, a opportunity evaluation framework wherein these six parameters help me understand how an opportunity could essentially scale from pre-seed stage itself, right? And I'm trying to encompass it in early stages. I'm sure a bunch of you have already raised your seed funding and looking to get growth capital. I'll mix it up a little. I'll bring in perspective of how when we look at opportunities, we are also doing the things we are doing at Alpha Fund. But starting with value creation or value capture. Fundamentally, if you look at any disruptive solution that has scaled, they are either basically working towards value creation, which means they're adding up to the market cap and scaling the market opportunity overall for the ecosystem. When e-commerce came into play, it essentially broadened the horizons of people accessing goods that were not available in their neighborhoods, right? So I could buy merchandise from somebody sitting in Kolkata while I'm in Delhi, right? But prior to e-commerce, it was only possible if I was going out into the market, into the shop front, and doing physical purchases. And that was only limited to the network of retailers that I would have in my neighborhood. Now, when e-commerce came into play, this was value creation because it created more jobs. It created an entire backbone and infrastructure into logistics, warehousing, the entire 3PL and 4PL structures to support this value chain. And essentially, more opportunities for manufacturers, producers, the intermediaries, distributors to basically identify newer avenues of distribution, right? In the same horizon, in the same dimension, if you look at quick commerce, one might say that that is value capture because there is an established network of general stores, merchant stores, specialty stores, convenience stores, modern retail out there, right? And typically, what we're now looking at is convenience at the palm of our hand. With a few taps, we can basically order groceries and it will be at our doorsteps in 10 minutes. Now, that essentially could mean that you do not have to go out there and buy that produce or that merchandise from your next door kirana store. But that essentially could essentially be valued as tapped as value capture. So that's the differentiation that I'm talking about. Now, while you are building your value proposition, when you're building your business, your technology is commercializing, you need to also identify whether you are working towards value creation or value capture. And a business can do both, as a matter of fact. So you have to figure out what business lines or avenues are essentially for value capture and value creation, and accordingly build your value proposition on top of it, because that will define your channels, that will define how you will structure your upstream and downstream relationships, be it your distributors downstreams or your suppliers upstream. So that essentially matters quite a bit. Now, market size is very critical because if you look at venture capital, any venture capital firm would want to bring in stellar results. And for that matter, every portfolio company, we expect them to do 10x, 20x. We have heard the entire spiel. The reason why we look at market size or TAM or addressable market is to basically have verified level data that whether this company will be able to scale fast in a period of 5 to 7 years to a scale that will essentially substantiate or necessitate the exit potential and exit timeline, which could be multiples on the invested capital, a great IRR, so that we can also basically bring value for our investors who are taking all the risk. Viability, we want to look at a strong path to profitability, a unit economics that makes sense with good gross margins. And typically, what we look at across horizons, and I'm talking from consumer goods to enterprise to deep tech, a typical 50% gross margin on the transaction or the annual contract value or the uh, subscription. The reason we do that is essentially to understand when we were scaling and there is market pressure from your competitors, the you can play around with the pricing power to still win the markets, right? Or effectively discount to take away business from the incumbents. Lastly, valuation, because again, while every investor is to an extent value sensitive, but more of us at every decision that we do is essentially a function of exit potential. We're looking at not the entry point, but essentially, the journey overall. That at what valuation will an investor invest in a company, and what scale will they exit? Now, typically, a pre-money valuation realistically for a pre-seed company or a seed company starts in the ballpark of 15 to 20 crores, and typical, 15 to 18% dilution, which is the market standard. And one of the reasons I wanted to highlight that. So, typically, at any point when an opportunity lands on my desktop, or effectively I'm listening into any pitch, these six parameters are something that I'm keeping a keen eye on to do my first level of screening. Now, hope that helps you understand how to maneuver and guide through the process. And this essentially should give you a sense of, what we look at, how we think about it. Going deeper, I thought, I'll also tell you about, when you receive questions from investors, how are they structured, what we look at, and this seven fits framework will effectively help you understand this, right? And not all the fitments are essentially true at every stage. A product market fit at pre-seed stage is not possible, but I've mentioned it so that we can cover later stages as well. But few things which matter absolutely at the time of fundraising. One is the founder market fit. You are pursuing a professional pathway to build your own venture, and at that same time, essentially creating more employment opportunities to build a product or solution which essentially solves for a certain problem out in the marketplace. There should be enough buyers that is given from the market size. But what we essentially look at when we're looking at the founders is what sort of unfair advantage or the wedge that they have by knowledge, by expertise, by just their capabilities, technical capabilities, or effectively building distribution networks and operations to fit into a certain market to solve that problem. Now, that essentially is the founder market fit, and that's the first thing that we look at. Now, essentially, simultaneously, we also look at founder investor fit, which goes both ways. Effectively, because you would want to basically partner with somebody who is like minded, who essentially shares your vision, who essentially shares your values to scale, and can be your X plus N, the nth element into your team in early stages to help you scale off, right? Now, to provide access, open up doors for various business opportunities, uh, to open up opportunities for partnerships, uh, additional fundraising, follow-on fundraising. Hence, investor founder fit is also very critical. Just like you would want to basically, take your due time, do your due diligence while choosing a life partner, it is as good as finding your life partner, your husband or your wife, because you will end up spending a lot of time with your investors in scaling up and during your horizons of your fundraising, let's say pre-seed. So for 3 to 5 years, this individual is basically your go-to person when you're waking up in cold sweat at 2 a.m. in the morning for one or the other reason, and there will be many more sleepless nights, and they will be next to you, advising you, helping you, but again in a passive capacity, not active capacity. So you would want to have a person with that kind of spirit to back you up when you're starting out. Essentially, markets and products have product market fit, which essentially we see when you have already gotten a product in place, it is out in the market, and it is basically getting early traction through various channels and distribution frameworks, right? Now, within go to market, product and go to market channels are also very critical. The reason I say it, and I'll take an example. For example, any goods which have low value, let's say up to 500 rupees, and they are frequently bought. And the frequency that I'm defining is, let's say, 30 times in a year or perhaps more, would essentially be a good fit for quick commerce or your hyper local marketplaces, because you know that you will actually have enough turnaround on the value that you will spend to do the customer acquisition. So customer acquisition cost that gets amortized over multiple orders. So once you acquire a customer, they like your product and service, they like your user experience, your ordering experience, they will end up basically procuring, purchasing more from the same channel, which is one of the reasons why we will see, Amazon loyalists versus Flipkart loyalists in India, and they essentially stick to the various, for various reasons, the brand appeal or essentially, the experience that comes along with it. So that is one of the reasons why channel fit is very critical. Now, in terms of enterprise, you could essentially go through channel partners, which could be global system integrators, ISPs. You have your distribution partners with B2B marketplaces, self-serve marketplaces. But depending upon how your product is structured, if it is an enterprise play, you have to have long decision cycles. You'll have to build an inside sales team. You'll have to have in-house BD, lead generation, and then basically technical sales going along. Essentially, if your product is something which is bundled as a tech product, a SaaS product, an enterprise product, you may end up basically looking at channel partners to to gain access to newer markets overseas. Now, typically, therein you let the other person do all the initial stages of lead farming, hunting, closing, and then you take care of and the relationship transfers to you for account expansion as well as servicing. Now, channel partners have been very prevalent, and India has basically built that playbook to scale all of our. If you look at the last 20 years, if I'm talking about Indian uh, macros, the global markets have looked at India as a as a venue for your IT services, IT enabled services, telecom, and exports of that. So essentially, if you look at that, all the SaaS companies, all the enterprise tech companies that have come up in the last 10 years have been able to scale at the backbone of GSIs that we have had in India, like Infosys, TCS, Tech Mahindra, with global distribution. And as in the last 5 to 7 years, we have seen global companies are coming in and setting up their GCCs, global capacity centers in India to build product and conduct R&D within India itself on their product lines. Because one, tech talent is comparatively cheaper in India. We have higher productivity, and essentially it's easier for them to basically, open up India as a market. India is a vast consumer and enterprise market in itself, and that is opening up different opportunities as well. So as far as channel goes, if you are working into healthcare, you would want to basically work with channel partners to do overseas sales, cross-border business development. If you are in India itself, you would still want to basically go via some channel partners or people who have your common go-to-market rails, so that you can essentially co-sell with them, right? It could be your payment partners, it could be essentially your upstream integrators or downstream integrators, or essentially, if you are an analytics or an intelligence tool which is working on top of an ERP, so ERP company, the SAPs of the world, the Salesforce of the world, could essentially be your go-to-market partners. Microsoft plays a huge part there. We have all seen it. So all of those things can essentially become a channel play. Alternatively, if you are into a deep science solutions, you are working on a deep tech product which has longer gestation or effectively in life sciences, you would want to basically go to institutional partners, which are your design partners as well. They could be essentially your initial customers. So healthcare companies, pharma tech companies are looking at pharma giants or healthcare giants to basically do early partnerships, so that once the IP has hardened, it has matured, these entities, these partners can essentially do licensing for distribution across geographies, right? We have seen multiple deals in our portfolio around that. I can talk more in the Q&A about it, right? Model and channel again is a fit, which again basically is a function of you. As you scale, you would want to basically do revenue share versus lead gen versus just your licensing model or royalty model. So all of those things essentially become a function of which channel are you working on. So while you are working out your fundraising journey, be very cognizant that all of these fitments are there, and depending on the stage, For example, in pre-seed state, like I mentioned, founder market fit, founder investor fit is super, super, super critical. Once you are basically out in the market, built towards product market fit and product channel fit, once these are stabilized and you're going deeper into scaling those opportunities and relationships, a channel model fit is very critical so that you are able to you're ensuring your 50% plus gross margin across various value chains. Now, broadly speaking, what I've tried to do is I've basically put up these four bullet points that has personally helped me, and when I've interviewed so many portfolio founders and founders that I've met in my journey thus far, these are four questions that essentially make a lot of sense for you, right? When you're looking to fundraise, the first question is how much should we be raising, and that needs to be as per the kind of milestones you want to achieve. So, how much do you need to achieve your milestones? Second is how much equity are you willing to give up? Rather, how much dilution can you withstand? Right? It's a function of, there is no exact science in early stages in terms of what valuation and what corresponding dilution should happen. And it is all a function of ensuring that once you raise capital, that capital is good enough for you to get to the next milestone. That milestone could be your next fundraise for growth, your commercialization cycles, launching up new products. So it has to basically line up with that so that newer commercial value is basically getting added to your balance sheet. So you're adding to the top line to some extent, or effectively, it could essentially also mean that you are going deeper into a certain product. So you're investing more into that. So you should basically be able to understand that while you're doing all of this, milestones are aligned. Simultaneously with your milestones, your timelines are aligned for your runway. While you're working on that, you understand the fact that in every stage there is certain ownership target that every investor would have, and that is again basically a mathematical formula which is mostly scenario build up in terms of what the exit horizons could be, right? So we all work on those scenarios. You can also basically just reverse engineer that thought process in your mind. Now, it also is a function of how much are the investors willing to invest, right? So build different scaling scenarios. I prefer having founders working on optimistic scenario, which is basically a stellar scenario wherein you get all the outcomes that you are looking for or assuming for in your models. Second is basically a modest scenario wherein you raise a little less. Your milestones are basically a little capped in comparison to the optimistic scenario, but you're able to scale to a point wherein you are in a position to either get to the step minus of your next milestone or your growth journey, or a pessimistic scenario in a market which is not very kind. We had seen the funding winter a couple of years back. We've seen valuation rationalization happening in the last 2 years. So when that happens, you might want to basically understand and tune down your burn rate so that you can manage in limited resources and scale up. Or, at times, intrinsically speaking, sometimes I've seen that during due diligence, deals end up falling, investors backing off. When that happens, you are able to basically quickly pivot, change tracks, change your vectors to essentially work on a different rate of burn to scale, and it's still essentially ensure that your product goals are at least whatever you need as a minimum should be met. So optimistic scenario, moderate scenario, and a little less moderate or pessimistic scenario, the minimum that you want to hit, and build those scenarios and corresponding growth models and timelines, and align it up with your milestones. Last but the most important thing, how long does it take to raise? And it is a function of time commitment versus mindshare commitment. Typically, a fundraising cycle is not more than 4 months, 4 to 5 months, if you are very efficient about it. I'm talking the first pitch to money in bank, which includes, your diligence pre-IC, approval from the investment committee, term sheet, negotiations, and then the larger due diligence and shareholders agreement negotiation, the rights negotiations that happen. And then the call to money happens and your drawdown happens and your money hits your bank account. So between all of these milestones, it is typically and efficiently as 4 months period. I'm talking in general. I'm considering pre-seed to Series A opportunities. So it's generally around that time frame. It could take longer if your DD or due diligence is slower, which again depends upon a few factors that I'll talk in subsequent slides. And mindshare. Typically, what we have seen is that it takes 80 to 90% of a founder's mindshare for that for 3 to 4 months period, because they have to consistently talk to one or multiple investors and their stakeholders, due diligence partners across legal, financial, compliance, and essentially, everyone in the middle, people like me, who are your champions internally into any fund, the fund teams. So all of those things combined, it takes 70 to 80 or 90% mind share to put together all the data packs, the deck, and then basically go out and make pitches and final commitments come in, and then you basically close the round. So be very cognizant and careful about when you're planning your journey. Might be mindful of that. It will take mind share. It will take time commitment. Okay, so now once you have basically logged in all of these 4 points into your mind, comes in, the first thing that we do is a compelling pitch deck, which I will break down into a compelling pitch and a compelling deck, right? Now, onto the left side, you will see these 10 parameters, which are effectively, sections of your fundraising deck. I have actually drawn inspiration from Guy Kawasaki's 16 slide framework, and it is basically a summary of that. Typically, this is the format that we see as a teaser pitch deck when we basically look at early stage opportunities, and that goes into a deeper data pack as well as a deeper deck, or business models or commercial models that you build out. But this is the first communication and the first collateral that you prepare. And alongside it, the most important thing is that while you're basically doing your pitch deck on a presentation form or various formats, you actually have a story to tell, and which is effectively what every founder practices. They build their journey around, how they came along, why are they working on this product, what is the motivation and incentive behind it, and why would somebody join this journey and be a investor in the journey, right? So it's not just about storytelling, it's about tangible representation of future success, right, of your venture in a credible way in the context of today. What it means is that your storytelling has to basically be strong with tangible representation of future success, that you will build a certain product which will be out in the next 6 months, 9 months, 10 months, and you're effectively looking at capturing a 5% market share, a 3% market share by year six, year five, or whatnot. And that you will, during this journey, year and year, you will basically scale at certain rate, let's say 20% every quarter. So essentially looking at doubling down by every fifth quarter, and build that journey and articulate it well. It should be concise with data that can back your future success. It should not be, uh, 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 while it is all storytelling, it should not be a gross fiction as a matter of fact, which is only imaginary. That plan of action should basically be built with, cognizance of what you have today. And if that fundraising happens, then you will basically be able to build it out. Have metrics, not just metaphors, be data driven. Ensure that you are categorically highlighting your right to win, which are your competitive levers. And going back onto the left side of the slide, within each of these, your competitive levers are exhibited. Your team, your talent, your diversity in experience to basically build such a company, build a team that will basically help you scale is very critical. The problem that you're solving and how large that problem is, what is the solution for it? Is there some IP that you're developing for it? How big is the market? What is your credibility in the market, and how do you think you will basically scale in that market? Your business model, whether it is industry validated or not, is there customer purchase intent? Are they willing to pay as to how much you are asking them for? Your traction, again, there are various metrics around it. We'll talk more in detail. Your competitive advantages, there are multiple ways to exhibit that. Again, 2 metrics across various factors is one of the most easygoing, but you can basically you can do various, I mean, there's a wordplay and there is graphics play. You can do leverage any of these. Your go to market, how will you acquire your first customers or your first set of partnerships or your first enterprise clients? What are your projections on scale growth, like I mentioned? And how much are you looking to raise? It has to be relevant because every investor will have their ticket size based upon the fund and the diversification or the portfolio exposure that they're looking for. Now, I was talking about growth metrics traction. I've tried to basically exfoliate this into four parts, which essentially starts with your user growth and engagement. People who are directly doing consumer goods, it could basically be, regulated goods as well. But you need to look at, the kind of proof of concepts that the POCs that you've had, the pilots that you've had in the enterprise domain, or active users do you have on a monthly, weekly, active, or a daily basis. What's your lifetime value of each user? How much are you spending on it? What's your account rate, churn rate, retention rate, transaction volumes? Again, these are more generic, trying to keep it agnostic. But if you have specific questions, we can take it up in Q&A. Financial performance, growth is critical. You're looking at product users, which is average revenue per user, what is feature usage, etc. If you are a pre-revenue deep tech company, capital efficiency and runway is super critical. You have to have a quick lock-in on what your monthly burn is going to be because revenue materialization is a few years or months or down in the future. So be very cognizant as to how will you manage or efficiently utilize capital that you've raised. What is the capital deployed, total raise, as well as what is the usage of fund breakdown that happened in the previous raises. It could be non-dilutive funding, which is your grants secured. Be very cognizant of the fact that, and I've seen this across various companies. We're talking to some very interesting, some of the best minds or brains in the industry, coming up with some very unique novel solutions. But when it comes down to uh, fund utilization, the mindset is basically more towards how do I represent utilization of funds to the grantor, the agency, right? They're not looking at it from the lens of the R&D efficiency and what an investor might want to look at. So be very cognizant that you are very clear about it. I know a lot of work has gone into, and the BIRAC team has done some fantastic work around it. We have learned a lot from them as to how they're basically helping their grantees present and utilize their the funding that you've got, the grants that you've gotten, in a manner which is very much synonymous to what an investor might want to look at. So R&D efficiency is very critical. Now, beyond the pitch deck, you have to create your virtual data room, which should have your financials, your corporate documentation, your statutory documentation. You have to basically put together all the documents around legal and compliance. Your product roadmap, architecture, your IP documents, your defensibility, all of those things basically are level 3, level 4 of details that any investor would want. So you would have to basically prepare these in this sequence as well. Now, typically, all of these things are basically post closure, so in the due diligence phase. Now, fundamentally, when you're looking to raise, these are four things that you have to keep in mind. Think of it like a business development funnel or sales funnel itself. You have to do investor targeting, find relevant 50 to 100 investors in the ecosystem, which are matched by your stage and the sectors that they focus on investing into, so that you're talking to the relevant people. Your outreach, leverage warm introductions. They have higher response rate. So reach out to people or networks or investors or founders you know in your ecosystem, or your colleagues or your alumni who may have known somebody or raised from somebody or a fund, so they can do warm introductions for you. Cold emails work, but again, you have to have a very compelling subject line, a teaser deck, and aim for at least 20 outreaches in a week. That's the magical number that I have understood after talking to a bunch of founders in our portfolio, that 20 odd outreaches in a week is basically just optimal for you to not be overwhelmed and underwhelmed or underutilized. You have to navigate your meetings. Just like I am running out of time and I've already shot the 11:40 mark. I should have already finished 5 minutes ago. You need to have a very good 10-minute speech and keep the track, right? Follow up with deep dives on metrics, like I mentioned, level 2, level 3, and level 4. Be open to input and feedback. Actively listen and adapt to that feedback so that you can actually, when follow on meetings, and it's good to have disagreements. It's good to know that the investors may think otherwise, but understand the fact that you are the experts in the domain. The other person is basically adjacent to your journey. They may be from the domain, but they don't know the problem statement or the market or the customer as good as you do. So be very cognizant. Disagreements are good. Agree to disagree, but and have diversity in viewpoints so that you are able to basically get the right set of diverse people around you who can help you not just by agreeing with you but also disagreeing with you at times when you are not making the right decisions. So you have to have that diversity in place. Practice mock pitches. Talk to your colleagues. Talk to your fellow co-founders in this cohort, and try to basically do mock pitches so that you can get feedback. Work it like a funnel. Have a CRM which will help you basically automate a lot of these things and build momentum in terms of follow-ups, weekly follow-ups, etc., etc. You can automate all of these things today. Now, 30 seconds here, not more than that. Typically, when you're looking to raise capital, there are couple of formats, couple of equity instruments. One is common equity shares. I'll share these slides with you so you can read through all of these things. And I've tried to typically put together when is it relevant, what is the founder's perspective on it, and investor's perspective, as well as what compliance does it follow, along with quick summary of what it looks like. Typically, in industry, you will see compulsorily convertible preference shares, which convert to equity shares after a certain time frame based on certain triggers, which could be qualified financing round, next funding round, a timeline, maybe just 2 years down the line or 5 years down the line, or effectively any future equity event. It could be an M&A, it could be fundraising, like I mentioned, or IPO, or effectively share buyback. This is a combination of what debt-like protection looks like with an equity upside for the investor. So it's basically balanced there. In addition to that, we have seen iSafe, which is basically typically for very early stage companies, pre-revenue companies. So it operates on the backbone of CCPS itself. But again, done in a very standard specified fashion. Our colleagues over the other side, 100x has basically fashioned it on top of what we see in the US, which is safe notes. So we are also basically working towards it. It's basically as good as convertible note. There are convertible debenture as well, which are CCDs and OCDs, optionally convertible or compulsory convertible debt, which converts to equity, again based on certain qualifying financing events in the future. These are some terms that I've basically highlighted, which are basically critical for term sheet discussions: valuation, liquidation preference. I've mentioned what standards in India look like, your anti-dilution, founder vesting, board seat and voting rights, transfer restrictions, and information rights. This initial slide is in itself a 2 hour long discussion. So I will not spend more time on it. But essentially, if you can read through it, I've mentioned all of the critical things that you need to know before you're moving into a term sheet discussion. And it is good for you to have somebody who is on your side as an advisor, maybe a friend who is an advocate, or maybe a friend who has already raised funding to get to run things off, to be have them as a sounding board. A few mistakes that we have seen people make while fundraising: not knowing how much to raise and when, not demonstrating proper competitive modes or plan for scale up, spend a lot of time there, have concrete imperative data, failing to research investors, right? Investor industry fit is also critical. Investor founder fit is critical, because eventually you're looking, like I mentioned, X plus N, the nth factor of you getting additional resources beyond capital, like advisory, which should be industry specific and relevant. So they have to have that experience if you're looking for it. They should be in a position to open up opportunities for you in the ecosystem. So industry fit is critical. They should have industry access. They should be able to help you raise in the future as well, right? So you have to do this research by yourself. And not preparing for contingencies is also basically very problematic, which is one of the reasons I refer to having optimistic, moderate, and less moderate scenario for your growth, and then accordingly fundraising. Ignoring feedback loops at that time kills the conversation. It brings a gap. So be very clear that you're following up diligently, and if there is any feedback or information required, you provide that properly. I see a lot of conversations going down or going into latent stages because of that. And then lastly, over promising and under deliver. So you make a lot of promise, but you don't deliver. Don't try to basically work on that. And that gets caught very early on. Here are a few recommendations that should help you in terms of your venture journey, regardless of what stage you are in, which industry you are in. I have found it very helpful when I was working on my startup. Over time, there are many other resources that have come along, but these three books, four books, Venture Deals, Lean Startup, Zero to One, Power of the Parlo, have essentially been covering the basics, which are still essentially true to its core. So they are universal, almost facts, not facts actually, but experiences that you will get from various investors in the market, and doing global, building global ventures. So that is that. Another podcast that I listen to, and it is helpful in early stages, is Jason Ye's Funded Pod. Subscribe if you're into podcasts and listen in. I'm open for questions. So if you're building a startup which is laser sharp on building solutions for India imperatives, which are deep tech companies effectively looking for helping India build a self-sustenance and self-reliance in the next decades, do reach out to us. We'll be happy to have a conversation. You can reach me at abhishek@timegroup.vc. My details are mentioned on the slide. You can also write to connect on LinkedIn with me. So yeah, thank you. And we are actively deploying from Alpha Fund, which is the second fund, and I'm sourcing actively for that. So let's have a chat. Open to questions.
Thank you, Abhishek. Thanks for this wonderful talk. And thanks again for the references. I think those are going to be very helpful for the newer people, newer founders.
May I
So,
say one thing? So I was split in my head as to what I should put forward to, but since you mentioned there will be people from various domains, so I
right.
did not go deeper into one specific sector. But when I'm having my one-on-one conversations, I can definitely bring in more resources that we have accumulated over the years for that sector itself, and essentially work it that way. So that could essentially be more targeted intervention that we can take up in the future.
Great, great. So Abhishek has been associated with Bharat Innovates from like quite a long time now. So he is going to be there for the national base camp also. So people can always interact with him. So a request to all the attendees to start typing in your questions. And meanwhile that happens, I'll take this opportunity to ask my naive questions. So, what do you think is the ideal team structure for a deep tech innovation, say something which is coming from biotech domain?
All right. So I think the roots of a lot of life sciences innovations has been researchers, uh, postdoc candidates, working into
Yeah.
their R&D. Sometimes even sooner in their masters. So essentially, the research that has basically been undertaken in various research labs across India. So professors are also basically getting into it, and their students, their research assistants, essentially become their co-founders, or their fellows become their co-founders. So typically, we have seen that ecosystem, bubbling up, and basically then
Hmm.
pivoting out to fan out to do a venture on its own, commercialize that technology or that IP that they've built. So essentially, it starts off with that. So the atomic value, or the nucleus of any deep tech venture, is basically the R&D team, right?
Hmm.
So we look at critically, the kind of relevant background and research experience that the team has had to the problem they're working on solving, right? We have also seen people who have basically worked in a certain domain, went out into the industry, worked in a certain different domain, and then found avenues and areas for scaling up or building a venture into a third domain, as a matter of fact, right?
Hmm.
But all of it has inklings, or if you look backwards, you can connect the dots as to how and why did they basically land upon this opportunity, and what do they know about that problem statement. So having the team which essentially can exfoliate this reason of why they're doing it, and their technical chops around it, is very critical. Now, in the first few years, which is effectively TRL 6, TRL 7, is essentially where you do not have any outbound business development efforts or opportunities that are happening. You still would want to basically build out industry relations, right? that is part of your future business development that you can do today to basically establish your company and start building the brand. So as soon as you have your IP and all secured with a patent, you have basically understood how will you commercialize it and what will be the final form of the product be like. Start building that brand around it. So somebody, I'm not talking different individual, but I'm talking a group of people who can basically share these skill sets, right? So I'm
Hmm.
talking about the skill sets that is shared across the group, right? Not a solo person, but
Hmm.
essentially shared around the group, and then they can work it out. But as we scale, we see that people take up one of these areas of work and go deeper and solely be responsible, and that happens. But initially on, when we're looking at early stage, we are looking at you know signs and inklings of two individuals in the team taking care of content marketing or taking care of business development and partnerships, while the other person is basically back in product development, right? Or essentially going out there doing technical sales because they're better at it, right? The other guy is basically in taking care of back operations, right? The R&D piece, product development piece, finances. We also see that typically uh, founders coming from this domain, owing to the fact that they have not spent mindshare and timeshare into acquiring skills which are basically more related to finances or legal compliances,
Hmm.
they lack at that, sometimes. But that's not to worry. You can always hire a virtual CFO, but do it on time, which basically becomes your extended support system. You can actually have your CA basically help you with it. So while in early years you don't have revenues, you only have burn to do. You are only
Hmm.
using a dilutive grants, dilutive funding or non-dilutive grants to scale. Having a CFO who is categorically helping you with what sort of funding or debt is needed for short-term goals or long-term goals while you're building assets is critical. So you get that right person. This is one mistake I've seen a lot of founders do. They utilize the source of funding into wrong places, right? Misutilization happens not for the bad intent. It is not misappropriation of funds, I'm saying. It is utilizing it for the wrong purpose, right? So if the grant says do prototyping, don't use it for your payroll, right? Or essentially operations or paying out the rent, right? So be very mindful of that. So having these skills is basically very critical.
Okay. So we have one question coming from Surita Sarkar. She's asking what points should be mentioned in a competitive landscape for fundraising and what points should be avoided while pitching to an investor.
Okay, avoidance though will never happen because follow-up questions will basically cover those. But okay, in first glance, you have one slide. You don't have too much real estate to spend on this. So effectively pick up your direct and indirect competitors in the space. The one pitfall that I've seen and things that to avoid, anybody saying we don't have a competition, right? There could be indirect competition, there can be perceived competition also, right? Your competitors adjacently might not be there, but the incumbent has the resources and the tech talent to build that product out after looking at you, right? In the non-biotech or the non-life science, non-deep tech ecosystem, we had Flipkart, but Snapdeal came along. There were other marketplaces too. And there is market which can actually subsume large players. 4, 5, 10, 20 marketplaces can exist in India. That's how large the TAM and the demand is. So essentially, what we look at is basically you highlighting which are your closest competitors by virtue of their IP, their consumer targeting, their value proposition, what they solve for it. And if there's a differentiation that you can highlight, okay, these are the parameters for where it's common, right? But this is a competitive edge. Highlight that, right? It could be pricing power, you are cheaper. It could be deployment. It could be direct outcome or the end result that the consumer might be looking for, because they would have to also understand the switching cost. I'm using a product A, but I want to now basically start using product B. So the company building product B has to lure me to basically change my habit or pattern of buying product A and or use that product in my enterprise solution and switch and invest into using product B. So that's very critical.
Okay, noted. So Srinidhi is asking how do investors evaluate vaccine startups, keeping R&D trials?
Okay, well, I can take an example of a venture center supported company that we have invested in last year called Lamarck, right? So they are into pharma, biologics, and building out a mechanism to thermostabilize various biologicals, right? Bioactives, right? Like insulin, like vaccines. So we have had a great experience of learning around it, not directly to vaccines, but this adjacent work. And I was on the transaction, so I'm talking more about it from experience, and trying to build an anecdotal learning here. So the one thing that we understood was that the validation came at various stages of scaling up. Uh, you essentially have your novelty around the target pathway that you're looking at, your target molecules that you're looking at, or proteins that you're looking at, and that has to be unique, that has to be IP protected. So you have gotten to a stage wherein the patent is already filed and there is enough novelty that you have basically proven through various methods. You have tested in the lab, the results are out there. You have done peer reviewed studies as well on that. Now you're in the process to commercialize it. And that is where we can come in and invest in supporting you for your uh, stage one, stage two, and stage three trials, or in fact, preclinical trials as well. You can look into that from that lens, but you have to have these uh, studies of efficacy or models proven, maybe through now there are various ways to basically leverage AI to do that, but proof that provenance has to be in place. It has to be documented, peer reviewed, and validated in the lab. And if you are basically beyond that scale and you're in the position to basically now do production, let's say a liter, 1 liter flask, lab scale production, that is helpful. The pathway for you to basically put together, what methodology are you having to basically conduct your next stage of trials, we look into that. So when you're talking about R&D, document all of it. Document your journey for your pre-IND stage of trials, stage one, stage two, stage three. What are the different protocols and procedures, SOPs, that you're basically putting together, right? How many candidates do you need? Have you basically applied for ethical approvals? So these are like checklists that can come in play for you to basically reach to the next stage. And we are also basically going to track and follow that. And at each stage, what were the outcomes that you got? It could be extrinsic or internal pathways. We can again validate all of that in conversations.
Okay.
That
So,
said, I also have a large army of experts in our LP ecosystem who come from the domain. They have been part of large pharma companies like Biocon, etc. So they essentially help us with technical due diligence and validation on the IP side of things, on the technology side of things. So we bring in these subject matter experts who are not just experts in the domain; they're also investors. So if they back you on the product side of things, they will also invest in the company, and that is how we will scale. So just wanted to highlight that.
okay. So, Ketan is asking, how can a pre-revenue deep tech startup set its valuation correctly?
Uh, this is ongoing conversation week after week when we invest into deep tech companies we look at. But typically the way we are looking at it is that it depends on the stage of the company, right? So if you are at a stage wherein you're TRL 6, TRL 7, and you're looking to raise, let's say, $1 million, right? What is the horizon of that utilization of that $1 million looking like? What will be the next stage of it, the milestone? So we look into the milestone and what stage will it be and how close it will be for commercialization. And when you commercialize, what will be the, I'd say, annual contract value or enterprise value that you sell one unit? If you're licensing out, how big will that license be? So looking into, the market imperatives, and they will not change. So let's say you're working on a space tech solution. Now you have to do launches, right? You will do hotbed trials, you will move into pilots, and you will do your first trial launch. So what stage is that? What is the utilization of funding? So these are very critical steps. And when commercialization is in sight, we work backwards from there to understand if you are thinking of commercializing it in the next 3 years, we will basically take a ballpark and say, if not 3 years, maybe 3.5, 4 years. But if you get in the time frame, what will be the market value of the company then if you scale it to that? So, there's a function of, looking into your pathway for commercialization, your next milestone, even if it is pre-revenue milestone, that is also okay, and IP hardening. Now, once we look into that, we look at generic dilutions that the company can withstand with different stages. Because if we take too much equity, the future investors will not come in. If we take too little equity, we will not be able to capitalize the company in a manner it should scale, right? So it is not just a function of valuation, it is basically an equation which includes your milestones, the amount of fundraise you're doing on top of it, and then essentially, the kind of dilution that you can withhold. I can give some numbers. So in pre-seed seed stage, think up till seed stage, you should be in the position to dilute, and I'm considering that you have taken up all available non-dilutive grants, CSR grants available out in the market, from right from SISF to your Genesis to what not available. You have taken everything. You have taken Shibri, you have taken big grants, everything. Then you are basically moving into raising the next first million. We ensure that you're basically at least moving into 2 steps closer to your commercialization, and that's that. So industry validation, commercialization, and typically up to 15-18% dilution. In some cases, 20% dilution is good enough. And because the next investor will come in and take up at least uh, up to 20% dilution. Though the time you have done Series A, you are 35-40% diluted, right? Yes, 55%. You're in 55 to 65% equity range, including ESOPs. So you have to basically capitalize on that. I'm talking about all the edge numbers, right? Talking, I mean, there could be lesser numbers. It's not set in stone, but again, these are ranges that, and I'm talking about the upper extremities that the founder can withstand, as a matter of fact, in terms of dilution.
Okay. So one more related question. So this is coming from Devesh Avasti. He's asking for a medtech startup who is at TRL 4 and is now moving into clinical validation. Do investors typically invest at this stage? What is their mindset? Since the actual market entry happens only after clinical validation and regulatory approvals.
So I can talk about us. With BioAngels, we are categorically looking at supporting such companies itself. We have invested in companies which were in the process of just getting their IP done, but we understood that market, the use case that they're solving for, the solution that they have, the team and the tech talent that they have on board will be able to solve that problem, right? And which came in with validation again, like I mentioned, from the fact that we have technical due diligence done with subject matter experts in the ecosystem. We may not know everything, but the network effects basically bring in collective knowledge for us to do that. So we do look at that, and this is the typical mindset. We are not, and again, like I'll go back to the previous response I had. When you're looking for clinical validation, have you gotten your ethical committee approvals, right? What will be the SOP for the trials going to look like? What are the parameters that you're basically endpoints that you're looking to validate by the end of that study, right? Is that endpoint validated by your host partner, or somebody who is basically co-sponsoring this or running this trial for you? Towards the end, take a holistic feedback from people out in the ecosystem. Look at companies which are in the same domain or similar domain as to how they had basically gotten market confidence, industry confidence, patient confidence, practitioners confidence, right? The doctor's confidence into whether this device will basically, again going back to value capture, value creation, right? Go back to that same point, value capture, value creation. If you are basically saying that I will provide you a device which will make this test cheaper, you are doing value capture because somebody is already doing it, let's say at the lab scale, but you're bringing it closer to the point of care. So you're now making it smaller, you're miniaturizing it, you're making it cheaper so that it can help in screening as well, right? A simple UACR dipstick test for diabetes, right? Or a nephrology use cases, right? So if you can capture it early, but at the point of care, what is the IP there? So we need to think of, how are you validating it as far as endpoints are concerned, and how relevant are those endpoints compared to the practitioner, the end beneficiary, the patient, and the hospitals. So we look at all of these things in conjunction, and yeah, so that's the level of you are the experts in terms of putting together all of these pathways and regulatory pathways. We are essentially there to fund it. So we'll look at all of those checkpoints and work it from there.
Okay. So we have many, many questions coming in for you. Probably I
Okay.
can take two, three more, and then I can reach out to you with an email, and I'll
So
try to get back to
I
you.
did provision another 20 minutes, 25 minutes. So if I'm okay with basically hanging around for a couple of as long as you want. I've freed up the
Okay.
next half an hour for you.
Oh, okay, that's great. So then we have time. So, and
Sure.
since you've already mentioned bio angels, I think there's one related question. So, for a startup in medtech's product, CDS code trial licensing and setting up regulatory approvals, they're all very capex intensive. So, are there any angel funding options available for such products, uh, especially when the government grants or the seed is not sufficient for such purposes?
Yes and no.
Okay.
And I'm sorry, I'm a little torn about it because without having specific knowledge of what you're building and where you're stuck
Hmm.
and what will be the next milestone, it's hard to basically say. But definitely, these are areas where we want to basically take up positions because the opportunity is right. The team is doing the right things. We would want to basically back it up. If the money is going into capex development, we have done it in the past. Uh, Companies have taken up series. And again, it's not just bio angels, right? Think of it from alpha fund lens also. So we invest anywhere from 1 crore to 25 crores. Our first ticket will vary between 1 crore to 6 crores, right? Anything which is basically 8 to 25 crores can come from alpha fund, right? And in the middle, if you're looking for a bridge round, we can basically raise it again from the angel fund, right? So we can subsequently do pre-seed, seeds, pre-series A and series A and A plus, right? When I'm saying A plus, we also do subsequent fundraising, funding, right? Take an example of Cerigen. We invested from the angel side of things first. And then we invested in the same company from Alpha Fund. This was perhaps the first investment that we did. We are also picking up our winners in the portfolio, existing portfolio, and a small portion of our newer funds are actually earmarked to invest into these companies and help them scale. So we are anchoring or co-anchoring those rounds as well because we understand we believe in the promise, right? So we can do that. And at that point, in various stages, the founders have raised money to basically set up production facility, a lab, a clean room, the entire R&D infrastructure in place, because at some point you will basically outsize or outscale the kind of infrastructure that is provided at an incubator, right? So beyond that, you will have to set up your own facilities at some point or start supporting the incubator with, renting those facilities at some point. So we also help with all of that. So effectively, utilization is where we basically take a holistic view. It's not that we will not do capex.
So, Logan Yagi is asking, do if we have a fully developed market-ready product before entering market, what are the important things which should be done?
Um, Chan- I think one of the critical things is basically validating whether the customers are willing to pay for it. Build the channel, and this is where the channel product fit comes in play, right? So if you look, can you give me an example of what this product is all about? Maybe Logan, if you can, if you have
Type
knowledge,
in,
or
I can.
which one? Which
I'm
domain?
asking Logan to type in, so
Okay.
because these people they can't switch on their mics right now.
Okay.
Yeah. Say, for example, it's a medical device. We can
Okay, medical
start
device.
with that.
So yeah, so I think before market entry, basically talk to at least one. So first of all, understand which geography you want to go into,
Hmm.
right? If you're talking about nephrology use cases, you would want to basically look at which states are basically having the largest load of nephrology patients on the
Hmm.
public health infrastructure, right? where screening is an issue, right? And when you're basically finally getting these issues, I'm talking nephrology within medtech devices, an example, right? Where do you basically find the most patient load? Now, build these hotspots on a map of India. Now, these are your first go to markets that you want to basically go after. Figure out who are the distributors in the domain, right? Through your network, outreach, a simple Google search will also lend us to basically who are different distributors in the domain. Do you want to basically build your own BD team within these domains? Be it MRs, be it basically your technical sales engineers, who are part of it, depending upon what product have you built. Now, let's say this is basically a point of care solution, right? For screening, for nephrology use cases, right? Can it be given to diabetologist? So club those pathways. Now, one way is to basically go directly into that market, have feet on street, go to every doctor and try to sell the device, or effectively go to the hospital and talk to the procurement team. Within that, which size of hospitals are we talking about? Now, what will be the procurement policy like? Like, do they have straight up pathway under 40 lakhs? If it's upper 40 lakhs, they will basically go through, your CEO approvals. You have to go to CFO. Your sales cycle increases, right? If your sales cycle is increasing, you would want to have a hybrid model of having your feet on street and a distributor is opening up your opening up the doors into these enterprises or these institutions, and your team basically go and does the technical pitch, right? And then basically ensure that your contract is there. So you'll have to basically figure out again a function of what's your ticket size, how much the customer spends on selling on, and their purchasing capacity, their purchasing willingness, purchase intent, and then essentially work it from there. So if you're basically working on all of these things as a plan, I think we are very sure, very clear that startups in our portfolio that have done it have been successful.
Okay. So probably Logan can reach out to you if he
Yeah,
has some more clarifications. So moving on to the next question. So Faiz Ali is asking, so we are converting a research project into a private limited company.
right.
At this early stage, how should we define or think about our company valuation?
I think I already covered most parts of it. Depending upon what this research product is, first of all, get your data sets, your pitch deck in place. Once that is there, you will have a clear entry into what market are you getting into. How crowded, or basically it's a red ocean opportunity or a blue ocean opportunity. How crowded that market is. Once you've got that sense, you will basically be in a position to also identify the value proposition, right? Now, valuation is basically a two-way discussion. You cannot think about or have it, bring it up in that sense. It's still pre-revenue. What is the money coming in for? Because we have to underwrite that risk. So we will basically an investor will basically build a profile of that risk. Just like insurance works, right?
Hmm.
The premium is high if the risk is higher, right? Similarly, there are different kinds of insurance and different kind of insurers to basically cover those insurances, right? An investor is also basically looking at how to underwrite that value proposition. Is the money going towards R&D or towards capex or towards setting up research facility or towards doing scale up, because you already have gotten a contractual contract party to contract agency to basically manufacture it for you. So we look into all of those things and then value it.
Okay. So Nitika Ashwani is asking, for a healthcare medical device startup, we are still in R&D stage and have a couple of LOIs. Can we show that as a traction, or what else could we portray?
So Ritika, depends on what those LOIs intend to do for you.
Hmm.
Is this the intention of the other partner is to basically provide you with, let's say, subsidizing the cost of your clinical trials, right? How are you basically planning that? Or will that partner help you with getting access to a host institution which will conduct clinical trials, deploy resources, also take you to, let's say, various regulators like ICMR and solve for that pathway? So that depends on what that LOI will basically lead to. If that LOI says, once this product is done, we will buy it.
Hmm.
Please come and think of it. Like if somebody comes to me, Abhishek, would you like to have a Mercedes Benz, right? I would say, yeah, if I don't have to pay for it, yes, why not, right? So, but when it comes down to the purchasing intent, the fitment, that is when it makes accounts for. So the LOI is basically towards, okay, we will purchase the product once it's out. It's hard to justify that because whatever is in the middle is what we are financing, and we want evidence and validation of that. And if that partner is accelerating this piece, that makes sense. And then on top of it, if they're also saying we'll buy or basically help you, get the first revenue coming in, then that's the whole picture.
Okay. So, AJ Carl is asking, when should a startup be valued? And when would an angel investor be interested when a startup is in pre-sale stage?
Okay, so AJ, you're right. In early stages, okay. One thing I want to quickly highlight: you will not find angel investors as we would do 15 years ago, right? Today, think an ultra HNI, ultra high net worth individual, or a family office, or basically a institution looking to expose or get risk into the risky, and this is the riskiest asset class, right? Startup investing wants to take exposure there. They would want to basically either go through an AIF, which is basically an angel fund, Cat 1 angel fund like Indian Angel Network, India IN Angel Fund. It is very rare that they are doing direct investments on the cap table. It is only happening when it's friends and family or you had worked with the person in the past. So your former bosses, the CEOs of your former employers, effectively are the ones who are basically writing those angel checks, right? Now, as far as friends and family is concerned, friends and family are not going to put in restrictions on you. Okay, I want a certain valuation like this or a certain valuation like that. The moment that discussion happens, they are not friends and family. They are just typical angel investors, right? But if that flavor of conversation is happening, a CCD will be making a lot of sense because it basically caps the downside and the upside for both parties. So you will not go beyond a certain dilution, and they will not basically get, miss out on the upside when they're basically backing this opportunity because neither you nor them know the future value of this company, right? You're essentially saying this will be worth so much, and let the future investor who may have more idea of what this market can be or how once your product is validated will be willing to get and take an entry should essentially price the round, right? Again, at that stage, it will still be CCPS, so preferred shares, but not converted to equity shares. And at the same time, it will still work in that sense. So you do a CCD or a convertible note, it will basically be a function of capping the value and then various trigger milestones to convert based upon your timeline, your milestones, and the amount that you have raised. Uh, it will be a function of that. So, but the value is basically again determined on the fact that if you miss that milestone, then your valuation is this much. If you achieve that milestone, your valuation is higher, right? So it is basically again incentive driven. If you basically achieve a product launch milestone and also clock in 100 customers, okay, now the cap is basically where the conversion will happen. So you can basically do a convertible note as well with triggers of how that conversion happens, right? So you can work a structure from that lens. So on one side, put together your milestones. In the middle, what amount you need for each milestone. A total is something that you have in the end in column B. Basis that if a certain hard milestone is achieved, you can have a X valuation. If a hard milestone A and B are achieved, you can have X plus, let's say, a certain higher valuation. But none of these are achieved, then you are legitimately required to basically compensate the person for the risk they have assumed because now you will go out in the market to raise more, right? But the other person's risk is basically not converted into the reward that you promised them. That's how it is, right? So you can basically work on that a capped model and a tiered model as well.
Okay. So, so there's one more question, but I'm unable to understand the name of the person. So I'll say person X. So our person X is asking, we have a tech idea which disrupts a traditional existing solution. What is the best method to execute the product solution? Whether he or she should build a brand which is going to be slower, or is it better to collaborate with an industry giant by sharing the technology?
Interesting. So it is very clear there is already a existing market there. There's a solution that's out there.
Hmm,
Now, this essentially is a disruptor to the existing method.
hmm,
Fundamentally, what we would want to understand, it is still a tech idea, on how disruptive it is. Will it replace the incumbent altogether, or will it coexist in the market by taking a certain some share of the incumbent, right? Now, think of it from the the Google versus OpenAI lens, right? Now, what has happened is Google had the entire market share for search in the world. It was the gateway to the internet. But the moment OpenAI, Anthropic came along, they started chipping away at the heels of the traffic that will go into conversational pathway to discover and learn and get knowledge. I could have done a Google query, but now I'm talking to a bot, and that bot is basically talking back to me and providing summaries rather than
hmm,
some links where I can go and I have to do level 2, level 3 to get that insight. But now I'm getting a summary out of it. So this essentially is basically taking on an incumbent, but a formidable play that the incumbent had to pivot to basically do Gemini, first Bard and then Gemini, to basically get a conversational play itself. Now today when we Google, we get a summary on top, which is again Gemini, but it is not
hmm,
conversational. So that product is packed with that. If you look into your Gmail, you get a response typed up already on as to what you might want to reply to that email with, right? Or essentially, your autofill or your suggestions that come into, okay, let me press tab and your sentence will be finished. So all of those things are basically again at the back of it is LLMs. Now the pathway has changed and which has forced the incumbent to think of it. Now in this case, I mean, you would want to basically go on your own, right? If you are basically working on a solution which will basically take away revenue from your incumbent, your competitors, and it will remain with you, and you will continue to basically scale it sizably. But if you basically think that this is somewhere where distribution is something not is already established, and you might want to just coexist with the system, right? So for rapid scale, you might want to basically have collaboration with another party who has distribution at their on their end, and you can basically leverage distribution. You can do licensing of it. You can basically do co-GTM. You can do a white label solution around it. And that again depends on the gross margin profile. As long as the gross margin profile of your white label solution is 70% plus, be very sure that that company will not get you the right value because you're earning 70%. They are doing a markup on your value and then selling it to the end consumer. So landing cost will basically be way higher. And that is where Coca-Cola comes to my mind, right? Coca-Cola builds this product, manufactures the syrup. Is the bottling company, the Varun Beverages of India, that are basically selling it and at a higher price. So they essentially take a piece of the pie. Now, Coca-Cola is not basically actualizing, the end market cap of Coca-Cola. It's the Coca-Cola ecosystem that basically, the Coca-Cola company gets a portion of it, one third of it, right? So 47 billion is what's going into Coca-Cola's kitty, but the market cap is what 300 billion on an annual the sales market sales, right? The market cap is even higher, right? So you need to think of it from that lens. So if you're building GTM, you want to partner up. You partner up basis synergies. Is it synergistic? Whether your partners are your customers, end customers, or effectively will they cannibalize your value chain? How exclusive is it, right? So you'll have to think of on those lines if you're going down that pathway. But if your product is supremely disruptive, it will take away key customers and it will expand. Then you might want to basically build your own distribution in-house so that you can always play around. You can always keep the lion's share of your revenue, right? And not to basically share it with somebody else. So you'll have to think of it and balance it from that lens. So again, depends on the market, depends on the product, depends on what the customer is willing to pay for. And is the customer already buying something like that?
okay. So Neetu is asking, we are currently at TRL 7. with a working prototype. Our challenge is that customer orders typically require manufacturing readiness, but manufacturing itself needs upfront capital. From an investor's perspective, how should startup like ours best position this chicken and egg phase raising funds?
This is the phase two. This is the milestone to raise funds. If you already have gotten a product which is a working one, you already have customers which have placed trial orders or pilots or POCs, and they are willing to buy. And they said, okay, we'll buy something more, right? You can basically look up for a contract manufacturer. You can look at for ensuring that raising capital to essentially get more inventory in place and then build distribution rails around it, build a BD team around it, sales team around it, and focus on growth, right? But if you come up with your conclusion is that there are no ideal manufacturers for that product and out in the market. Can you just do sub component supply from your suppliers, right? Some parts which are you're non-trivial and they're basically taken up by third party. All the critical trade secret IP-led opportunities which are which are supposed to be kept in-house can basically work in the assembly or basically the end stream of the production line, which can be in-house, right? So you can work it from that lens. But again, you have to basically have all of this in place. But this is where you need capital for. So once you've essentially laid out that plan and you have validated it, why not? You may be tempted to say that, I want to raise capital to set up the R&D facility. Investors might not like it because investors might still think that you can go do contractual manufacturing first, scale to a certain point, validate in that market. You have got intent from a couple of customers. But are there 1,000 others to basically also buy that? Or will this customer also scale their order volume, account expansion? So prove that and progressively scale and then basically have this facility in house. Considering various regulatory constraints also, you know, you may want to basically consider having a third party do some parts of it because they already have worked out that leverage in terms of fire safety, your GMP, all those compliances in place so that you are regulatory approved as well, right? You have to have FSSAI, you have to have SEDESCO approvals, you have to have all of these things. So depending upon which sector you are in or domain of product you are in, you have to basically figure that out from a regulatory lens as well. So if the regulatory requires you to basically set up an in-house facility, I think the investors will be more than glad to invest in it.
Okay. So Praveen is asking, we are at TRL 8 with defense product and would need to get funding for other project contribution and in servicing the order once PO is raised. How investors normally work with investment needs that are stable, say 4 to 5 CR for 2 to 3 years, and also 4 CR that is needed for 4 to 5 months to service the PO.
Um, so I'm a bit confused here. When you're saying 4 to 5 crores for 2 to 3 years, that is for the interim to service the PO, is my assumption, or 4 to 5 crores for 4 to 5 months period, right? I'm just okay. All right. So if you're looking to raise, let's say 4 to 5 crores for 2 3 years, and then 4 to 5 crores for 5 months period, do you want to consider basically going for if your contracts are already in place? Do you want to go for a convertible note or basically just pure play debt? Maybe go to TDB, get cheaper debt to basically service that. Investors will be more than glad to basically invest in it. But the thing that I'm not able to understand, if you're at a scale wherein you require 4 5 crores to basically do a PO, why will you only need 4 5 crores for 2 3 year period? If the product is strong, you might want to basically double down and basically scale in the market, get leadership position. So assumption is you might require more than 4 to 5 crores for 2 3 year period. But today, if you're looking for 4 5 crores for a PO, yeah, so that again can work out. But think of it from the landscape. You can basically club it for a 8 to 9 crore round and raise the entire 9 crore as a matter of fact. Because if you are at a TRL 8, you have PO, you might have a certain valuation expectation. For that valuation expectation and the ticket size, once you do the investor mapping, you might go to investors who are doing 4 to 5 crores, but then the valuation will be high for them. So they might not like because it is rich for them. They might just want to co-invest because their capacity and their fund structure doesn't allow that to do that portfolio diversification. Then you might want to go to an investor who can also write $1 million check and can do it in tranches, right? By the way, this is where I'll cue in my value proposition. One of the reasons why IAN wanted to be a single large horizontal platform for early stage investing is to solve for these things only. You're looking for pre-seed, you're looking for Series A, we'll do it in tranches, we'll do it in multiple stages of the round. And yeah, I think like us, there are other investors and our counterparts in the ecosystem. We are all here to basically support such needs.
Noted. So, Sonali Srivastav, she's asking from TRL 4 level to market in a biotech product, what is the time frame the investors look out for?
It is subjective, super subjective. Uh, it's really hard for me to answer it without knowledge of what market is it and who is the end buyer. Is it the hospital? Is it the patient itself or the doctor? What pathway is it? Right. It is very subjective. So once I have an understanding and I can connect later on, do a
We
one-on-one.
have an answer. B2B. She says B2B.
B2B.
Yes.
Then in B2B, then it comes down to the market size and what segment they are into, right? What stage, who are they selling it to? So again, it's not easy. It's a function of things, but in general, if it is a B2B product and you're looking for the timeline, right? Sorry, could you repeat the question again?
Just a second. From TRL 4 level to market in a biotech project, what is the time frame the investors look out for?
So within
TRL
this
4 to market.
tier 4 to market के अंदर आपको सारे clinical trials भी करने हैं, right?
Hmm.
And you'll have to basically figure out all the pathways and regulatory approvals. That might take a few years, right? It could essentially
Yes.
be as low as 2 years and it can go as high as 5 years, maybe at some cases, right? We have seen that happen. You essentially have roadblocks, you conduct your clinical trials, and then you don't get the right outcome or the endpoint doesn't prove your hypothesis. And you may have to pivot, a hard pivot on what the IP or the utilization or whatever the endpoint that that biotech product is going to have, right? And we've seen it in a lot of companies like Vedanta Biotech, Biosciences that I was looking at. They were doing live, bio therapeutics, and they actually had to pivot in this clinical stage to clinical trials. And once the pivot was done, it was now for a different pathway altogether and different end outcome altogether, and which essentially also affected their valuation. The reason I'm highlighting this Vedanta Life Sciences is because I recently read about them. Right, I was working on the domain and I read about them, and I think you should also Google it, and you might get all the details as to why they pivoted from the, you know, they were working towards now solving for irritable bowel syndrome, but prior to that they were working on some other pathway. So you might want to basically look at such cases, and that essentially can extend your market go to market.
Okay. I think I've asked you to overstay, but two more questions I'll take
Sure.
and then we may close the meeting. So,
Yeah,
what type of modes do you find most compelling at Series A? Data distribution, regulatory, or network effects?
all three, all three.
I see. So, do you want to grade them? Like, what is more prioritize them maybe?
See again, data. You may not have regulatory safeguards, right, as a mode for yourself, but you may have data at your side because if you're working on, let's say, a Gen AI or basically AGI based industrial solution, wherein training the data is basically where your IP is, right? Your differentiation is the quality of the data that is there. It is proprietary, right? Or effectively procured from a proprietary partnership. Your competitors cannot get access to it. So that's very relevant. Or effectively, it is very, very hard for them to get. So in such a case, I will not look at regulatory as much. as much as what is the model looking like. How comprehensive is the model? It is going to be a small language model or basically a small Gen AI solution, small model. But when you're training this model, what is the data? Where are you getting the data from? Your competitor cannot get the data. And how soon can you go into the market, get active enterprise customers to feed more data into it? And how your RAGs and RHS, like feedback loops, are basically worked out. So, as an example, data becomes the key moat there. Regulatory moat is when you basically have, let's say, US FTA approval, which basically makes you, it's a midterm moat, but it basically helps you accelerate your go to market. So that's again depends upon which domain you're in is critical. If it is again a space tech or a defense tech product, so procurement and basically type certification is also very critical. So that becomes your regulatory moat. If you're the last one was basically, I think, IP,
Network effects.
network effects, and that again depends on distribution. But network effects again is a function of when you have the right partnerships which your customers cannot, right? So if you're a pharma company and you basically crack a licensing deal with basically Reckitt Benckiser, why not, right? So or GSK, why not, right? Or effectively, somebody licenses your product to basically fund your late stage trials as well as basically manufacturing and takes it out into a certain market, your geographic license, why not? So all of those things basically become very, very critical.
Okay. So now last question for you, Abhishek. So we have sold our product to US under investigational device exempt. Will Alpha Fund support us for commercializing in US, get FDA approvals and MD SAP registrations?
The short answer is yes, subject to the fact that you're raising in India or in the US entity. If you're raising in the US entity, that might be a concern because we have our LPs are sovereign funds, which are government fund of funds like SEDB, like Sri Capital. So our focus is India focused, India based, India imperatives, right? So companies headquartered in India, IP is in India, building for India, but global solutions, right? So if you are headquartered in India, then we can definitely look into it.
Great. Thank you so much, Abhishek. I think with this, we've covered most of the questions and thanks for overstaying. I think we had a wonderful Q&A session. You were very kind to everybody and answered them with so much patience. Thank you so much. It was a pleasure to have you here with us.
So Rashid, pleasure is mine. Today I actually am on leave because and then morning was free, so this is time well spent into rather than doing anything else. I will be in Gandhinagar. I am arriving on the 18th and I'll be there till I think morning of 20th. So I'm more than keen to basically, have FaceTime with your team, yourself if you're there, all the founders that will come in and present there. If they're in exhibiting there, please write to me or drop a line. Let Rashi know. I'll be happy to come by and find you and meet you. So we can always, utilize the time to, have more conversations.
Great. Thank you so much. He's already shared his number and email ID, so please keep pestering him. I think he is going to respond. He seems like a person who's going to respond.
I
So thank
definitely
you.
will. That's the job. But be patient with the turnaround because, again, if I'm late, it's purely because you guys have just all come at once.
Great. Thanks, guys. Thank you. We may close this meeting. Thank you,
Thank you.
Abhishek, once again. Okay.
Good day, everyone. Thank you.